Imagine you're standing at a crossroads, one path bathed in bright, tempting light, the other shrouded in shadows and uncertainty. Everyone's rushing toward the light, dazzled by the shine, ignoring the warning signs flickering at the edges of the road. That's exactly the moment we are in, and that signal, flashing red, demands your attention. There's a silent shift happening beneath the surface. Innovation platforms, robotics, artificial intelligence, energy storage, blockchain, genomics are no longer distant dreams. They are quietly gaining momentum. These are not fads, these are tectonic changes reshaping our world. In a world that rewards the comfortable and the conventional, betting on comfort often leaves you behind. What many see as risk, I see as the front row seat to the future. Because innovation is not just the next step, it is the whole new ladder. While many cling to old structures, waiting for slow, incremental gains, the real opportunities lie where disruption meets conviction. The powerful lies in long-term thinking. Short-term noise, media hysteria, cycles of fear and greed, those are distractions, nothing more. The true investors, the real visionaries, measure success in years, not quarters. They understand that building real value takes time. They know that when you invest where the world is going, not where it's been, you give yourself the chance to capture exponential growth. This is not about jumping blindly. It's about discipline, research, and bold conviction. It's about seeing beyond the herd, past the safe zones, and committing to transformation now. When you lean into the known, the familiar, you limit yourself. But when you dare to believe in what's next, in technologies that can redefine industries, you open yourself to possibilities that far outshine any short-term certainty. We live in a time where patience is rare, and yet patience might be the most powerful weapon we have. When others panic at every dip, when many will fold under pressure, you must stand your ground, because those dips, they are not threats, they are invitations, invitations to step in while the world still underestimates the power of what's coming. If you listen carefully, the signal is already there. It's calling you to see the bigger picture, to think about decades, not months, to invest in change, not stability, to believe in the future even when fear is loud. Because the greatest gains are rarely made by following the crowd. They're made by those who see ahead. This is your moment, not to follow, but to lead, not to wait, but to act, not to fear change, but to seize it. Because the signal is clear, and your future depends on whether you heed it. Here's a 600-word expansion on warning, the signal every investor is missing, in a tone inspired by that bold, visionary style, sharp, direct, and compelling without naming who it is modeled after. Imagine markets soaring, headlines glowing, bulls basking in the glow of record valuations, and almost everyone smiling. But just beneath that optimism, a silent alarm bell is ringing. Few hear it, fewer heed it, and yet history shows, when smart investors ignore that alarm, the fall is seldom gentle. Right now, one of the clearest signals flashing danger is an inverted yield curve when short-term interest rates exceed long-term rates. This anomaly isn't random. It's a cry from the bond markets signaling belief in future growth is weakening, and economic slowdown may be brewing. Since the 1960s, almost every major U.S. recession has been preceded by such an inversion. Invest +2, JP Morgan +2, but many dismiss this signal today as old school, outdated, overshadowed by new macro realities. They say we live in a different age. They think central bank actions, global capital flows, and innovation change the rules. Perhaps, but when fundamentals like bond yields start whispering warnings, it's not safe to assume history no longer matters. That's only one signal. Look deeper, and you'll see more. Broad market valuations stretched to extremes, speculative fervor rising, pockets of growthitany, cost investing in certain sectors, all signs that echo past bubbles. In prior market disasters, excessive leverage and speculative toxic optimism masked the coming crash until it was too late. Mulu +2, trade funder +2, even more subtle yet powerful, different asset classes behaving in lockstep. When stocks surge even as indicators like bond yields or credit spreads warn of trouble, That divergence, or rather, that denial becomes a dangerous bet. Often when these walls crack, the domino effect hits broad markets fast. Medium +1, and then there's the silent danger of consensus euphoria, when everyone seems confident, when this time it's different, becomes the mantra. That's the same phrase echoed in eras before the dot, calm crash, the housing meltdown, and other brutal corrections. The Daily Economy, org +2, Wikipedia +2, but this signal, the real warning, isn't about sensationalism. It isn't about fear mongering, it's about clarity, it's about probability, it's about preparing, because when you recognize the warning signs before you were ahead, when you ignore them, you risk being swept away. The smart investor, the one who sees opportunity where others see momentum, doesn't dismiss these alarms. They don't wait until the headlines scream crash. They plan for resilience. They ask, if bond markets are telling us something, shouldn't I check my exposure? If valuations are sky high, shouldn't I hedge? If speculation is rampant, shouldn't I seek value instead of hype? This isn't about abandoning hope. It's about tempering euphoria with wisdom. It's about giving yourself a chance to weather storms. Because when the crowd runs blindly toward the light, a cautious few, the ones listening to the true market signals, may steer clear of the cliff. If you're listening now, don't shrug off the yield curve whispers. Don't ignore the undercurrents. Don't assume this time is different. Instead, acknowledge the signals, respect them, let them guide you not into panic, but into prudence. Don't let the roar of the crowd drown out the quiet truth. Imagine you're watching a parade of numbers, charts, and headlines, and almost everyone's cheering. Markets are buoyant, stocks glittering, optimism everywhere. But behind the spectacle, there's a different story being whispered by the bond market, a signal few are listening to. That signal is the shape of the yield curve, and right now it's flashing one of the most reliable warnings history has to offer. When short-term interest rates exceed long-term rates, the slope of what's called the inverted yield curve, that moment when the safe maturity becomes the risk, something changes beneath the surface. This inversion isn't noise. Historically, an inverted yield curve has preceded nearly every major recession in the post-war era. Morningstar +2, Mulu +2. It's not just a warning for economists, it's a wake-up call for every investor. Because when the yield curve flips, it alters the balance of everything. Banks tighten lending, credit becomes harder to come by, risk moves up, and what once seemed like promise begins to feel precarious. CTAL Digital Solutions +2, Equity Default +2. Meanwhile, many are still dazzled by select flashpoints of growth, a few mega-cap tech stocks soaring, some sectors booming, and they ignore the broader undercurrents. That's a mistake. What looks like strength can easily turn fragile when credit tightens, borrowing slows, and expectations shift. What makes this moment critical is not just the inversion itself, but the fact that it's lasting. The sentiment baked into the bond market now reflects something deeper, widespread expectation that the economic runway is narrowing, the motley fool +2 Congress. Gov +2 for investors who want to see beyond the noise. This is the time to act. It's not about panicking, but about positioning. Reassess risk, evaluate allocation, consider resilience over exuberance, because when the broader economy stutters, it doesn't care about fashionably high valuations or hot sectors. This signal doesn't guarantee a crash tomorrow, nothing ever does, but it tilts the odds. And history shows, when you heed the bond market instead of chasing the headlines, you often leave the chaos behind, not because you predicted the future, but because you respected the signs. So listen, observe, position yourself not for hype or hubris, but for clarity and strength. When the critical signal no one is talking about grows louder, the wise respond before the storm. Imagine you're perched on a tightrope high above, everything looks calm. The crowd below applauds every upward step, but there's a gust of wind, nearly invisible, shifting beneath you. If you ignore it, that wind could send you tumbling. Right now, the markets are giving us a gust, a signal so powerful that ignoring it might cost you far more than money. There's one warning light flashing that's impossible to rationalize away: the yield curve inversion. When short-term interest rates climb higher than long-term rates, something fundamental has shifted. Historically, that inversion has preceded almost every major recession and market crash over the past 50-60 years. Nasdaq +2, Mu +2. What that inversion tells you without fanfare is that optimism is fading beneath the surface. Investors are choosing safety over risk, long-term confidence over short-term greed. Lending tightens, risk premiums rise, and credit flows slow. What once fueled bubbles, cheap money, leverage, speculative frenzy, begins to drain away. Urban Pro +2, my blog +2 at the same time. Valuations have stretched well beyond historic norms. Price-to-earnings ratios have climbed. Valuations that feel justified in the heat of a bull run suddenly look reckless in hindsight. Overvaluation, when paired with excessive leverage and speculative fervor, has historically marked the calm right before the storm. Mulu +2, best life +2 add to that the danger of collective human weaknesses, herd behavior, overconfidence, the belief that this time is different. When markets surge for years, many start to think bubbles can inflate indefinitely. That's how enormous collapses are born, when rational caution gives way to reckless enthusiasm. European Central Bank +2, my blog +2. If you ignore this, you might miss not just a correction, but a collapse. The risk isn't only in falling asset prices. It's in leverage unraveling, margin calls, forced selling, liquidity drying up, portfolios being wiped out. This cascade effect doesn't spare even those who think they're safe. Once panic spreads, correlation spikes, seemingly unconnected assets fall together, and diversification fails just when you need it most. Wikipedia +2, RZiv +2, that's why this signal demands respect. It's not a vague hunch or a sensational headline. It's a measured, data-driven alert from deep inside the financial system, from credit markets, bond markets, investor behavior. If you treat it like noise, you may wake up with a shock. Prudent investors aren't reacting out of fear, they're acting out of clarity. They're reassessing risk, reducing exposure to overvalued assets, deleveraging where possible, and thinking long-term, not in the next quarter, but in the next cycle. Because fortune isn't just for those who chase the highs, it survives with those who heed the warnings. If you see what's coming not as doom, but as a call to reorganize, you give yourself the chance to survive the storm, maybe even thrive when the dust settles. Because ignoring this signal could cost you everything.